Hi, this is Jim Femia. I'm a senior financial advisor with Apella Capital. Joining me today is Pat Sweeny. Pat is one of the founding partners of Apella Capital and Symmetry Partners, who along with his partner, Dave Connolly, founded the firm in 1994. In today's short video, we're going to give you a brief history of the firm. We are going to discuss our overall investment strategy, and we're going to explain the importance of minimizing portfolio expenses. So Pat, thank you for taking the time to join me today. Appreciate it. So let's go back in time. Let's go back to the late 90s. Could you maybe talk a little bit about how you and Dave ended up leaving your positions on Wall Street and started an independent firm?
Sure. It seems like a long time ago now, right? It's over 20 years when we left what we call a wirehouse, but a large national brokerage firm. It was Dean Witter. It's a fine company, but the philosophy at those large national brokerage firms is for their advisors, their sales force, to sell a lot of the company's proprietary investment products. And over the last 20 years, we've seen a decided trend away from that. But 20 years ago, it was commonplace to be asked to sell a certain amount or a certain quota, a dirty word now on Wall Street, of a particular company's product. So we didn't like that. We thought there was a better way to do business. And we left and started our firm in the fall of '94. And we could focus on financial planning and using the best investment options available for our clients, regardless of where they came from. We could tell to our clients anything that we thought was in their best interest as opposed to what our employer thought was in their best interest.
Okay. Can you talk a little bit about the relationship between Apella Capital and Symmetry Partners?
Sure. Apella Capital really is mine and David's original client base. So when we left Wall Street and started our business, we were financial planners taking clients one at a time, just like you've been doing over your career. And we kept those clients as the firm branched off into different directions. Symmetry helps advisors across the country grow their business, provides an outsource solution for investments and marketing. And that business grew very rapidly. We kept our own client base all those years. We were very loyal to our clients because they were loyal to us when we started the business. And a couple of years ago, we decided we should spin Apella Capital off to its own company. It shouldn't be part of Symmetry. It should be its own company. Dave and I still own it, and we share space together. The two firms are in the same space. But Apella now is growing rapidly on its own once again, and bringing you in and other like-minded advisors is our plan to grow the company going forward. So Apella, in a sense, is a client of Symmetry and leverages Symmetry Partners' research capabilities and marketing capabilities.
Great, great. As an advisor, one of the things that most impressed me was the level of conviction that you and members of your team have in your overall investment philosophy and how you rely on academic research as opposed to research coming out of Wall Street.
Right.
Can you spend some time talking about some of the academic research that you do follow and maybe some of the key influences for you over the years?
Sure. Key influences, right away I think of Jack Bogle, the founder of Vanguard Group, who really I think the champion of the retail investor, the small investor. And he was my introduction to indexing. And as probably many of you know now, Vanguard, the firm he founded, is the largest mutual fund firm in the world. And most of the assets that they manage are index mutual funds, something that we think are great and we utilize ourselves in our strategies. So learning about Mr. Bogle led me to a book called A Random Walk Down Wall Street. I think it's wonderful reading for anybody out there who cares to read about this type of thing, written by Professor Burton Malkiel. And in it, he referenced the work of Eugene Fama, Ken French, Robert Merton, Merton Miller, on and on and on. And these folks were all college professors, mostly out of the University of Chicago. And so just being a big reader, I enjoyed that story. Here are these college professors doing this work, and people like David Booth, the founder of DFA, Jack Bogle, the founder of Vanguard, and fast forward a few years, Cliff Asness and David Kabiller, the founders of AQR, they all come from that same bolt of cloth. They all come from that school of let's get our research from a place that We believe it can be reliable, conflict of interest free. It's gone through a tremendous amount of peer review, and let's take it and see if we can create real world solutions for people. That work started in the 1950s. The investments started in the early 1970s. And really not until the 1990s did individual or retail investors get access to it.
Right.
And so hindsight being what it is, we were early on. But I think it was like any other fun story to tell. It was as much being in the right place at the right time. And we got access to these professors. And now we have PhDs from area universities on our staff. In addition to having access to some of the greatest minds in financial economics. We still speak regularly with Professor Femia, Professor French, and their contemporaries at Chicago, Dartmouth, Harvard, the best schools in the country. And they share their research with us, and it's done very well for our clients, and it's done very well for our firm. So we have no changes in mind.
That's great. That's great. There's been a lot of research over the years about the importance of minimizing expenses within a portfolio, which Symmetry has been at the forefront of, obviously. Can you discuss the different types of fund expenses that sometimes a client will see and sometimes they don't see, sort of the internal or the external or the intrinsic and the extrinsic funds?
I call them explicit and implicit fees,
Okay.
and all those words are appropriate. So when we first started our business, we didn't have our big brokerage firm as the custodian of the client's assets anymore. So we went out and we would use companies like Fidelity and Schwab, household names, great companies. But they had to be paid as well for holding the money. And so they would charge a fee on some of the investments we used because those investments were very low cost, institutional oriented investments. And I'll give you some examples of that. But it was a much more transparent way of doing business. But clients would say, hey, I've never seen this fee before. Well, that's because it was embedded in the investments they were buying from the other companies they were using. So you're paying these things whether you see them or not. And some people like to think out of sight, out of mind. Not so in investing. Very important you understand what you're paying because as you alluded to, any fees associated with the investment process come out of returns. The lower the fees, the more money in the investor's pocket. So it's really just a question of transparency. And that's what's important for investors to understand. What are you paying? So let's get back to your question. Explicit fees are the expense ratio of a mutual fund. So a mutual fund will take their fee right out of your account, out of the fund, and you can find it in the prospectus. I know everybody out there has read a prospectus, but certainly we can tell you what those fees are. An advisor's fee, that's an explicit fee. You're paying your advisor a percentage of assets under management or perhaps a hard dollar for a plan or what have you. You'll see that on your statement. Those are explicit fees. Implicit fees are those fees that are not readily visible. And sadly, our business still, I think, has too many of the fees an investor pays embedded in investment products, and they're difficult to find. And so the approach that we've been taking, one of the positive byproducts of our approach is that we've been using these institutionally oriented investments. I'll give you one example. AQR, one of the fund families that we use that you'll see on your statement, stands for Applied Quantitative Research. And AQR, the share class that we utilize here at Appella that we have access to has a $50 million minimum per mutual fund. That doesn't apply to our clients. AQR looks at Symmetry as one big client. So that share class has very, very low expenses because very large sophisticated investors put their money in that fund, typically pension plans, endowments.
So the average investor would not have access
would never
to
have access to. So now as a result of that, these companies like AQR, DFA, Vanguard, all of them, they don't share their revenue back with these custodians, Fidelity and Schwab. So Fidelity and Schwab must get paid for what they do. They do a good job. They're the custodians of your money. They generate the performance. They generate the statements. They do the trading. They make it all happen. So they must be paid as well. So on a statement, your client will see, here's the mutual funds that I own, and here's Jim and Appella's fee, and here is Schwab or Fidelity or TD's fee. All those fees together are far less than what you're paying in a traditional retail investment product. So they're just broken out for you to see. And there has been a move towards transparency in our industry.
Right.
It started with the 401k space. Now it's going to happen everywhere, and that's good for consumers. You should know what you're spending. These implicit fees that are difficult to see, you should understand what they are, and an informed, educated investor is a better investor.
That's great. Thank you, Pat. Really appreciate you joining us today.
Great.
If any of you happen to have questions on this video or about your own personal financial situation, please reach out to the email or the phone number that will be tagged on at the end here. And again, thank you very much, and thank you for your business.